I've been a strong advocate for high-income ETF and have extensively discussed their numerous advantages, especially for retirees and income-focused investors seeking stable cash flow. However, there's another crucial advantage that I think all investors should take advantage of, especially as we enter 2024 amid discussions of a possible market correction and excessive greed sentiments. Let's delve into this further. One of the fundamental principles of successful long-term investing is portfolio rotation and rebalancing. This involves adjusting the composition of your portfolio by reallocating assets to maintain desired risk and return levels, often transitioning between growth and value investments. This approach is essential for managing downside volatility and maximizing growth opportunities. However, in today's economic environment characterized by AI-powered market surges and elevated interest rates, the traditional shift from growth to value investments may not be as effective. This is where high-income ETF play a crucial role in the investment strategy. Now, let's explore a specific ETF that could serve as a core holding in investors' portfolios going forward. I'm talking about JEPQ, the JPMorgan NASDAQ Equity Premium Income ETF. This ETF is experiencing significant inflows, indicating strong investor interest. JEPQ can be a valuable tool for rebalancing portfolio risk in the current economic conditions, especially because it provides exposure to the AI sector, a major driver of market highs. As the markets reach unprecedented levels, concerns about a potential correction are mounting. However, predicting the timing of this correction is challenging. Additionally, shifting from growth to value investments may not be the optimal solution due to various factors, including rising interest rates. The upward trend in 10-year Treasury yields, which are now approaching 4.3%, is particularly worrisome for value and dividend ETF. Investors typically turn to value stocks for risk management and income, but with short-duration bonds offering higher returns without added risk, the appeal of value investments diminishes. This situation is compounded by a robust economy and persistent inflation, which could lead to prolonged high interest rates, further dampening the outlook for value ETF. It's crucial to monitor upcoming economic data, such as the PCE inflation data scheduled for release on February 29th. Any unexpected spikes in inflation could significantly impact the market, particularly affecting value ETF and causing Treasury yields to rise. Finally, it's important to note that the exceptional returns seen in ETF like SD during the record low interest rate period of the 2010s may not be achievable in the current environment. That's why I strongly believe in the importance of maintaining exposure to growth. Nowadays, an increasing number of companies are incorporating AI to enhance their sales and revenue. That's why not long ago, I created a video discussing the advantages of focusing on ETF like DGRW rather than SD for 2024. In simple terms, DGRW provides more exposure to this AI trend. However, the second concern is psychological. It's becoming more difficult for individuals to justify purchasing shares of growth stocks and ETF at their peak prices. You might wonder, will the trend continue upward, or should I wait for a dip? My perspective is that the AI sector remains robust, and individuals shouldn't let the fear of a potential market correction push them away from a bullish trend. Additionally, any correction that does occur might be minor. Therefore, the question arises, how can you maintain maximum exposure to AI-driven growth without exiting the market rally and minimizing your risk exposure? This is where JEPQ becomes relevant. I've been closely monitoring JEPQ daily performance and have been quite impressed. Sometimes its resilience surprises me. Now, let's cover the basics of JEPQ for those unfamiliar with it. JEPQ is a relatively new fund established in May 2022, yet it already manages nearly $11 billion in assets, indicating substantial interest from major investors. The ETF has an expense ratio of 35% and an impressive dividend yield of almost 10%. How does JEPQ operate? It invests in stocks within the NASDAQ 100 and sells out-of-the-money call options against its holdings, generating significant premium income distributed to investors as dividends. However, it employs equity-linked notes ELNs instead of stock options. The primary distinction is that index options, unlike stock options, do not necessitate selling any shares if the index price surpasses the call option's strike price. Instead, everything is settled in cash, and the cash settlement is determined by the difference between the index's closing price and the call option's strike price. Although a covered call ETF like JEPQ caps the upside potential, depending on its covered call strategy, it can still position investors to benefit from upward movements while mitigating volatility with income from options. JEPQ allocates up to 20% of its assets to selling call options against the NASDAQ 100 index, usually with options 5% to 15% out of the money, based on the discretion of the portfolio manager. Now that you have a grasp of how the ETF operates, let's explore why it's an ideal investment for rebalancing in today's economic climate. Comparing JEPQ performance to QQ and the S&P 500 reveals its outstanding track record. It has consistently outperformed the S&P 500 since its inception and has kept pace with QQ despite utilizing covered calls. While its holdings closely mirror QQ with minor variations, particularly in healthcare and consumer cyclicals, this similarity ensures exposure to the AI and semiconductor sectors. Although 20% of its assets are allocated to equity-linked notes, resulting in lower sector allocations, JEPQ employs a secondary screening approach to adjust its individual stock allocation, offering a slight advantage over QQ at times. This strategy is evident when comparing the price returns of both ETF, focusing solely on NAV and excluding dividend distributions. I was pleasantly surprised by JEPQ resilience, especially in early 2024 when QQ experienced a 2% decline. JEPQ only captured 50% of that drop, falling by just 1%. This pattern has repeated itself on multiple occasions. Initially, I expected JEPQ to mirror QQ's price returns during downturns, but with added cushion from dividend yields. However, JEPQ risk management measures, reflected in its distinct holdings compared to QQ, have mitigated the impact of potential corrections in AI-focused stocks to some extent. While the difference may seem modest, the advantages are significant. The inclusion of dividend distributions provides additional protection due to substantial income. Reviewing JEPQ total returns since inception, it effectively compresses QQ volatility, cushioning downside during bear markets by nearly 7%, while missing out on around 7% of the upside. This indicates reduced volatility exposure without compromising growth potential. Regarding risk assessment, I find the categorization of investment characteristics on Seeking Alpha quite valuable. JEPQ boasts a top A+ rating in risk, surpassing QQ's lower rating. These tools are essential for managing performance expectations in a market reaching all-time highs while preparing for potential corrections without shifting to inferior sectors. If you're keen on leveraging these tools, I recommend taking advantage of the offer before it expires. You can save $50 on the premium plan by signing up through the link provided in the description. In summary, JEPQ strategies significantly reduce annualized volatility by almost 40% more than QQ, coupled with a superior standard deviation score, offering critical insights into potential returns for investors. This approach is crucial for navigating a market at historic highs and preparing for potential corrections without compromising growth opportunities. Instead of investing a lump sum into JEPQ or QQQ, consider dollar cost averaging into JEPQ, which maintains strong exposure to the ongoing AI trend that could persist for an extended period. You can then hold the dividend income as cash in a high-interest savings ETF, adopting a more conservative approach. Alternatively, you have the option to continue dollar cost averaging into JEPQ or switch back to QQQ based on your preference. In case of a market correction, you can utilize the reserved cash to gradually reinvest into QQQ or other growth stocks, taking advantage of the current high interest rates. Avoid selling or shifting towards the value sector or increasing exposure to value stocks due to potential downward pressure in that sector. This caution applies to JEPY, which focuses on value investments and may not be suitable in the current market conditions. Additionally, note that during a significant market correction, your dividend income may rise due to increased volatility. If JEPQ appears too risky, another excellent option is ETFH, which further reduces the volatility of QQQ. Overall, the AI trend continues to grow, and unless there's a major unexpected event impacting the markets significantly, the trend is likely to continue. On another note, mark your calendars because I recently came across a VIX term structure chart indicating that investors are pricing in high volatility by October 2024. This spike in volatility could be attributed to various factors, including upcoming elections, but it's notably high. I'll delve into this topic in detail in my next video as it's quite intriguing, and I believe all investors should closely monitor it. That's all for now. If you haven't already, remember to subscribe to my channel and hit the thumbs up button for the YouTube algorithm. Thank you all for watching, and I look forward to seeing you in my next video. Goodbye.